What's up, Coach B here with another episode of Chalk Talks with Coach B. I know it's been a while and I've been talking about doing this for quite some time. So here it is. New playlist today I'm starting is going to be options trading strategies for beginners. If you're new to options, I suggest you check out the options basics playlist first before starting here. Today we're going to start with leaps. Okay, you've probably heard the term, maybe not. Maybe you've heard me talk about it on my stream in the past. LEAP stand for longer term equity anticipation securities. Basically, it's an options contract that's greater than 9 months out. But for me, for this strategy, I like to give myself at least a year. I really think this is the safest type of play to begin with if you're new to trading options because they offer plenty of time and they also give you an opportunity to leverage your money more than you could with buying shares. So whenever I buy leaps, I like to stay around the money or in the money. More often than not, I'll go deeper into the money because my goal, again, is to build a position in the stock and I want my price action to reflect the same way as if I bought shares. If I'm going really far out, like more than a year, I might go closer to like maybe right outside of the money. But the key here for me, typically, and especially with this strategy, is going to be to get as close to a zero point 0.8 delta or higher. And to achieve that, we normally got to go in the money. Now, why do I want a 0.8 delta? Well, remember from the video we made about delta, for every dollar the stock moves, my contract price will increase by the delta. Okay. And my goal here is, again, is to simulate shares. So I'm bullish on this stock. I want as close to dollar movement as I can get. So with the 0.8 delta, I'll get an 80 cent increase in my options contract for the first dollar movement and likely more afterwards. But let's take a look at the options chain and see if this makes a little more sense. All right, so here we are. We're looking at the Disney options chain. I know it's my favorite for examples, right? Low IV sitting right around 33%. And looking at the chain here, the first opportunity we have that's at least 365 days out looks to be about January 20th of 2023. So we'll go ahead and open that one up. Now, Disney right now today is trading at $171. We'll keep that in mind as we go forward. If I wanted to buy 100 shares today, it would cost me somewhere around 17,000. But let's look at some leap contracts now. Again, these are called leaps because we're more than a year out, more than 9 months out. Now, if we look at this, here's our delta column right here. I said I wanted to look somewhere around a 0.8 delta, and right there we see the 135. Let me raise this up a little bit. All right. So 0.8 delta, and as you can see right here, that's right around that $135 strike. Okay. And the contract right now looks like it's costing right around $45.50, which is going to basically cost me one contract $4,500, which is pretty good, compared to 17,000 if I wanted to buy 100 shares. And if I'm really bullish on the stock, I could buy this contract and make almost the same dollar for dollar movement as I would if I bought shares. I'm also giving myself well over a year to get the price, a piece of this price action. So my upside, again, I'm going to buy this contract here for one contract for $4,550, okay, as opposed to paying $17,000 for the shares. Stock's trading at 171. As the stock goes up to 172, my contract price will move up, roughly to about 46.30. Stock goes up to 173. My contract price will move up to about 47.10, and so on. So I'm going to get at least 80% movement because I have that 0.8 delta. Now that can fluctuate, and that'll get to increase as we continue to move forward. But anyways, my upside is pretty much limitless, right? I mean, it's the same way it would be if I had shares. The stock can go to infinity. I'm going to continue to get that, movement for every dollar the stock moves. Now, my downside is pretty much fixed too. It's $4,500.50. That's how much I put into it. If this stock goes to zero overnight, that's how much I'm going to lose. So that's my risk there. If we look at the value of the contract, right? So we're looking at $135 strike. We're paying $45.50 in premium. We add those together, we're basically looking at, $181, $180.80, somewhere around there. Break even at expiration, where we want to be. But I would imagine it would move way more than that. If we're trading at 171 now, I'm bullish on this stock. I have well over a year. I'm expecting more than a $10 move. So, anyways, what this is telling me, I'm paying basically, 145 or 135 plus 45, like I said, 181. And that's basically saying that $36 of this is intrinsic value and 950 of that is technically premium value, something like that. So even if the trade goes against me, I should be able to get out with the stop loss or manually and salvage some of my premium the same way I would with shares. So again, let's say if you would have bought these shares at $17,000, and all of a sudden Disney pulls back and it ends up trading at 165, and you wanted to get out, you could do the same thing here. Stock loses $5, your contract's probably going to lose $5. So, where you paid 4,500 for it, maybe you could sell it and get out early at 4,000 and cut your losses short a little bit earlier. But again, what you're risking, the maximum risk here is 4,500. Now, let's see here. Not only is this a cheaper way to get the price action of a higher price stock, like we just said, 4,500 as opposed to 17,000, but it's also a way to maximize your leverage. So if we were to buy 100 shares of Disney today, it would cost 17,000. One contract at the 135 strike was 4,500. Both give me similar price action. Give me for over a year, I get to get that dollar movement as the stock goes up. While the shares definitely pay out more, it's going to be pretty similar. But what if I had the capital? What if I had 17,000, sitting there ready to go? I could pretty much afford 3 contracts. That would put it somewhere around 13,500. And now I get triple the price action. And if I really like the stock and over the next year it goes up like I thought, I also have the opportunity to, let's say, maybe sell 2 of those contracts for a nice big hefty profit, and then take that money and exercise that 3rd contract, for 13,000, and now get those shares for $135 because that's the strike price I bought it at. There's a bunch of options you have when you do these things, but really at the end of the day, I think leaps are the safest. It's an easy way to kind of get your toes wet, get involved in buying some call contracts, giving yourself plenty of time for the stock to mature and even withstand some dips in the market, and still have, like I said, build a position in a stock that you like, that you're bullish on. Either way, hope you enjoyed the video. I hope it made sense. I'm hoping to get more of these coming out soon. As always, hit the like and subscribe button if you're enjoying the content. And be sure to come check out my live stream every morning during pre-market, Talking Stocks with Coach B.